Hi, we need to, in this module or in preparing a statement of cash flows, whether we prepare using the direct method or the indirect method. Again, there's two methods companies are allowed to pick from. We've been doing the direct method. The indirect method is a little harder to understand, or it's not as intuitive when you read it. It starts with net income, and then you make changes to it to get to cash from operating your business. So you get basically from an accrual-based number in net income to a cash-based number called cash from operating activities. The direct method is the same idea, but it's easier to read. It starts with cash collected from customers, and then it itemizes has line items for all of the cash paid to get cash paid for operating activities to get to cash from operating activities. What I'm going to do in this video, though, is hope for you to see the general effect of changes in current assets and current liabilities on cash. Our income statement, our revenues would be exactly the same as cash collected from customers if there were no receivables or if there were no payables, or excuse me, deferred revenues. So in other words, having receivables or having deferred revenues makes our revenues different from our cash collected from customers if those accounts change during a period or exist. So let's look at, in general, the way you can understand whether you need to increase your income statement amount or decrease it by looking at your change in a current asset or current liability account. In general, if you think about it this way, if you have an increase in current assets, that means you have some other current asset instead of cash. Or you could have had cash, but instead you have accounts receivable, or if we're talking about expenses, supplies, inventory, prepays. Those used cash indirectly. I mean, you could have had more cash, instead you have more of those. And then the opposite is a use. So basically, instead of using cash, you use these assets so that you're, again, if we want to look at sources, when I compare an income statement line item to the related current asset account, if the current asset account went down, it's going to be more cash paid or less cash collected. It's a use of cash, and vice versa. Liabilities, let's look at those now. In general, current liabilities, if they go up, that means you gave IOUs instead of cash. That's the source of cash. So it means that whatever's on the income statement is going to be less than the cash, the related cash amount. So if we're talking revenues, we would add it, meaning if this was deferred revenues and there was an increase in deferred revenues, it means I collected more than I earned. If we're talking payables, it means I gave IOUs instead of cash. So my expense on my income statement will be greater than my cash paid. All right, because it means I didn't pay for all my expenses. I hung on to some of that cash. And then the opposite, if your liabilities go down, that takes cash. That's a use of cash. So if we're talking about deferred revenues, that means that if it went down, it means we did not collect as much as we earned. If we have a decrease in a payable, it means we not only paid all our expenses, we paid even more to get this balance to go down. So in both methods, the direct and indirect requires us understanding whether a change in the related current asset or current liability is the source or use of cash. So you know whether to add or subtract it to get to, or get from the income statement to the statement of cash flows. So I hope that helps. There's lots of, not lots, but you'll need to figure out a logical way to analyze these so that you can come up consistently with a correct answer. So I like using debits and credits. You can use pluses and minuses. Again, I have other videos to show you that.